$7,500. That's the most a person under 50 can put into a Roth IRA in 2026. Sounds small, but put that number on repeat for 4 decades. Let the stock market do what it's done for the last 100 years, and you're looking at a number most people never believe is possible until they see it written down. Let's start with what a Roth IRA actually is, because most people have heard the name without understanding the mechanics. It's an individual retirement account, and the Roth comes from Senator William Roth, who pushed it into law back in 1997. The idea is simple, but the tax treatment is what makes it special. You fund it with money you've already paid income tax on. No deduction today. But once that money is inside the account, it grows without ever being taxed again. No capital gains tax, no dividend tax, and when you finally pull it out in retirement, the withdrawal itself is completely tax-free. The government collects nothing on the growth, ever, as long as you follow the rules. For 2026, the IRS raised the contribution limit to $7,500 for anyone under 50. If you're 50 or older, you get a catch-up contribution on top of that, bringing your total to $8,600. But this account isn't open to everyone regardless of income. Single filers start losing the ability to contribute once their modified adjusted gross income crosses $153,000, and it's fully phased out at $168,000. For married couples filing jointly, that range sits between $242,000 and $252,000. Earn more than that, and the front door closes. Though, as we'll get to, there's a legal side door. Why does this account get so much attention from people who actually study personal finance? 3 reasons stand out. First, decades of compounding without a single tax drag. Most investment accounts lose a chunk of their growth every year to capital gains taxes, especially if you're rebalancing or selling winners. Inside a Roth, that friction disappears entirely. Second, there's no required minimum distribution. Traditional retirement accounts force you to start pulling money out at a certain age, whether you need it or not. A Roth never makes you touch it. You can let it compound untouched for the rest of your life if you choose. Third, it passes to your heirs tax-free, which makes it one of the cleanest wealth transfer tools available to an ordinary saver. Now compare that to a traditional IRA, because the difference in philosophy matters. A traditional IRA gives you a tax break the year you contribute, but every dollar you withdraw in retirement, contributions and growth alike, gets taxed as ordinary income. A Roth flips that. You take the tax hit up front on a smaller number and then never deal with the IRS on that money again. Here's a simple way to picture the difference. Say you're 25 years old, sitting in the 22% tax bracket, and you put $7,500 into a Roth this year. You've already paid roughly $1,650 in tax on that money as part of your regular income. Let that grow at a historical stock market average of around 10% a year for 40 years. And that single contribution could turn into roughly $339,000 by the time you're 65, and every cent of it comes out tax-free. Run that same $7,500 through a traditional IRA instead, and you'd owe tax on the entire withdrawal decades from now at whatever bracket you land in. If your income is even modestly higher in retirement than you expect, that tax bill can easily run into 6 figures on a single year's contribution. Now stretch that out to a full career. Contribute the maximum every year starting at 25. Assume the account grows at that same 10% historical average. And by 65, you're sitting on a balance in the neighborhood of $3.5 to $4 million. funded by contributions that only added up to around $300,000 out of pocket. The rest is pure market growth, untouched by taxes. That gap between what you put in and what you end up with is the entire argument for starting as early as humanly possible. The first 10 years of contributions in your 20s end up worth far more at retirement than the same dollar amount contributed in your 40s, simply because they've had more time to compound. Most people also don't realize how flexible this account actually is while you're still working toward retirement. Inside a Roth IRA, your money splits into two buckets: what you personally contributed and what the market has added on top through growth. The rule that surprises almost everyone is that you can withdraw your original contributions at any time, for any reason, with no tax and no penalty. It's the earnings, the growth portion, that come with restrictions. That means a Roth IRA can double as a genuine backup emergency fund, a source for a first home down payment, or a cushion during a job loss, without the penalties you'd face pulling early money out of a 401k. There's a 5-year rule worth knowing too.
Your account needs to have been open for at least 5 years before you can withdraw earnings tax-free and penalty-free, even after you hit the standard withdrawal age of 59 and a half. That's why the advice from almost every financial planner is the same. Open the account now, even with a small amount, just to start that 5-year clock running in the background. There are also built-in exceptions that let you tap into earnings early without the usual 10% penalty. A first-time home purchase up to a lifetime limit of $10,000, qualified education expenses for yourself or your family, and situations involving disability. These exceptions are part of why financial independence communities treat the Roth IRA as more than just a retirement account. It's a flexible tool that touches nearly every major life event. For people chasing early retirement, there's a more advanced move called the Roth conversion ladder. The idea is to build up both a traditional 401k and a Roth IRA during your working years. Once you retire early, say at 50, your income drops sharply, which usually drops your tax bracket too. Each year, you convert a slice of your traditional 401k into your Roth IRA, paying tax on that conversion at your new, much lower rate instead of the higher rate you were in while working. Each converted amount then needs to sit for 5 years before you can access it penalty-free. So people build a ladder of conversions, one every year, so that by the time they need the money, a new batch becomes available right on schedule. It's a way of bridging the gap between an early retirement date and the age when retirement accounts normally become fully accessible. And for high earners who are locked out by the income limits, there's the backdoor Roth IRA. It works like this. You contribute to a traditional IRA on a non-deductible basis. There's no income limit on that. And then shortly afterward, you convert that same money into a Roth IRA. Because you never took a deduction on the original contribution, the conversion generally triggers little to no additional tax, especially if you convert quickly before any real growth happens. It's a completely legal, well-documented strategy, though it gets complicated if you already hold other pre-tax traditional IRA money, because the IRS applies a pro rata rule that can make part of the conversion taxable. People in that situation often roll existing traditional IRA balances into an employer 401k first, to clear the way for a clean backdoor conversion. One thing that trips people up constantly: opening a Roth IRA and actually investing inside it are two different steps. A lot of people fund the account and then just let the cash sit there, earning next to nothing, because they never selected an investment. The account itself is just a tax wrapper. You still have to choose what goes inside it, whether that's a broad index fund tracking the S&P 500, a total market fund, or some mix of stocks and bonds that matches your timeline. Because everything inside a Roth grows tax-free, Most long-term investors lean toward putting their highest growth assets in this account specifically, saving more tax-inefficient investments for other accounts. Consistency ends up mattering more than almost anything else in this whole equation. Missing even a handful of years early in your career, or contributing half the maximum instead of the full amount, can cost hundreds of thousands of dollars by the time you reach retirement age, purely because that missed money never got the decades of compounding it needed. Someone who contributes the full amount every single year from 25 to 65 will, in almost every projection, end up with dramatically more than someone who contributes twice as much per year but starts a decade later. The bottom line is straightforward. This is one of the only accounts in the entire US tax code where the government asks for its cut up front on a relatively small number and then never touches the money again, no matter how large it grows. Open one as early as you can, automate the contributions so you're not relying on willpower every month, invest the money instead of leaving it in cash, and let several decades of compounding do the rest of the work.